Well, hello, this is Jim Musgrave with Research Financial Strategies, and welcome to the Q1 2018 Market Recap. Well, we've been very busy this first quarter. We started off going down to the Circle of Wealth Conference down in Orlando. We then went to the ETF conference down in Fort Lauderdale area. And we had a wonderful client appreciation dinner in mid-February. And it was great to see a lot of you there at the dinner. And at that point, I kind of did a recap of the markets. And, things have changed quite a bit in the last couple months. But one of the things we've been doing a lot is a lot of financial workshops. And just before I get started, we have a number of different workshops coming up. The next ones are coming up at the Dolly Madison Library in McLean on April 19th. It's going to be a Social Security workshop. This is going to be really special because I have Andy Robertson, the gentleman who actually created the workshop. He's actually my mentor when it comes to Social Security. He's actually going to be giving that workshop on the 19th, so you don't want to miss that. And then I'm giving the Investing for Retirement workshop at the same place a week later on the 26th. Then we're going to rotate back to Rockville in May for another round of the Social Security and Investing for Retirement workshop. So we're really trying to do two workshops a month and rotate between Rockville, McLean, and Silver Spring. And we're also looking in doing something down in D.C. and possibly in Howard and Prince George's County. So all you have to do is go to my website, jimmusgrave.com/events, and see when the latest workshop is coming up. And I hope you guys can make it. Okay, well, let's just kind of dive right into it. The S&P 500, I like to show big picture stuff here, where, here we are, March the 9th, 2009, and boy, the market has just exploded since then, up and over 290%. Yeah, we've had a little bit of a correction here at the top, but that's okay. That's to be expected once we've had a really long kind of bull market. And we'll see right here that, if you look back into history, you're going to see in many, many up years, they had times during that year where the market was down. So, the market, peaked in late January of this year, and the SP was down roughly 10%, but it's regained much of that territory. But you can see, again, you go back to multiple years, that we had certainly negative numbers, but we ended up on a positive note. So again, we're only one quarter into the year, and so still I think we're in a good bull market. Now, what I want to show you with this slide is this is the big picture stuff. Regardless of how old you are, you need to have some allocation to stocks. And if you just look at this 20-year chart that compares cash, bonds, and stocks, there's a huge difference. But at the same time, you also have to reduce the losses in your portfolio. And I keep on, mentioning this in my videos here, and that's really part of my investment philosophy. And that's one thing that we do at RFS very well, is that we tend to manage risk. And to kind of show you, so if your account dropped 20%, you would need a 25% rate of return just to get to break even. Much less getting, going down to negative 30, needing a 43% return just to get to break even. So even when we're in a long-term bull market, you still need to pay attention to minimize those losses. And so at this point, I'm going to get into this a little bit more in just a few minutes, but now is probably a good time to be a little defensive. Again, you can have these pullbacks in a long-term bull market. And again, getting defensive and kind of switching between offense and defense is something that really you need to do to make sure that you don't have to make up lots and lots of ground when you have these big losses like this. Okay, so overall the economy is doing well. GDP is in the mid-2s, and that's kind of where it's been for a while. And the other thing is that consumer confidence is still doing pretty well. It's about where it was, actually a little better than what it was before our last recession back in 2008. So, the consumer confidence is actually pretty good. I think that has a lot to do with, the tax cuts, and the economy is doing pretty well. And the market obviously has done pretty well, actually since 2009. So, I think consumer confidence is up pretty well. But, the big story right now is what is the Fed doing? So, obviously, when you have bear market recessions, the Fed has to lower interest rates to stimulate the economy, and eventually they have to raise rates to get back to normal. So you can see that the rates between 2008 and 2015 were at historical lows, and now obviously the Fed has started to raise rates a little bit. So the Fed is going to do that on a gradual basis. They're not going to shoot up, but what that's doing is that's going to cause a little bit of turmoil in the fixed income markets. So let's talk a little bit about that. So what's interesting, I love this chart. It's the yield chart, and you can see this blue line right here. The difference between, let's say, a 3-month Treasury yield or Treasury bond and a 10-year is not very much, and that also applies to CDs. So today I just bought a CD in a client's account. It was a 6-month CD, and we got it for 1.85%, and we had a 9-month CD for about 1.95%. So there's not that big a difference, between shorter and longer term, duration or yield, CDs and bonds right now. So, that's kind of where we are. There's not a lot of benefit to buying a CD or a bond that has a long duration. So, because again, in a period of rising interest rates, there's an opportunity cost. Because that sometime down the road, maybe 6 months or a year or two, that you can get a higher yield bond or a higher yield CD at that point when you have a slow, steady increase of rates over time by the Fed. So just to kind of put this into perspective, if you had $100,000 in a CD, let's say back in early 1990s, you can make roughly $8,000 on that. But look at where we are in 2017. If you had $100,000 in a CD, you made a whopping $408 last year. Big frickin' deal. And that really kind of shows you, when they lowered interest rates, that could be positive for borrowing money. But if you are a retiree trying to live on fixed income, that's a real problem. That's really what's been the problem since the last recession. So as the interest rates go up, again, the yields on the bonds go up and also CDs. But the also thing is that inflation also rises at the same time. So that's one of the reasons why we don't keep all of our money in savings or under the mattress, because inflation eats away at the purchasing power. So again, typically as interest rates go up, so does inflation. So they kind of go hand in hand. So we're going to see a little bit of inflation and a little bit of rise in interest rates in the near future, but that's certainly to be expected, and that's kind of what we're expecting in the upcoming future. Okay, and really what's happening is that the Federal Reserve is basically selling off a lot of their balance sheet, and again they lowered rates, but they also did what we call quantitative easing, and that happened in 2008. They did round 1, round 2, round 3. And now they're trying to actually, get some of these bonds off the books. So the Fed is going to do this on a gradual basis, and it's going to cause a little turmoil, a little bit of volatility in the fixed income markets, and that's to be expected. And that's what's going to happen in the foreseeable future. And one of the things that again really concerned about is obviously the duration of the bonds. That the longer the duration of your bonds are, the more vulnerable they are to interest rate risk. And if you look at the average duration, it's roughly 6.1 years when you take the average of the duration and the yield of the Bloomberg Barclays U.S. aggregate, which is the AGG is the ticker that we use in ETF world. So really what that means is that as interest rates go up, then bond prices go down. So this is I always love this chart because it shows you that a 1% rise in interest rates shows you about a 4.6% drop in a 5-year U.S. Treasury and about an 8.2% drop in 10 years and over a 17.3% drop in a 30-year U.S. Treasury. So again, the further you are out on the yield curve, the more vulnerable you are to rise in interest rates and further losses in your bond portfolio. So that's why you really need to keep the duration short and be aware of what you own. And most people I just see have no idea what they own in their bond portfolio. And so that's something to really pay attention to. Okay, now moving on. So let's get to the charts. And so, this is what I talked about in terms of the bonds. This is the aggregate bond index that I just mentioned. So you can see as interest rates go down, the AGG goes up, but when the interest rates go up, the AGG goes down. So that's essentially what's happened. And you can see this little section right here in the last week or so, how that's kind of ticked up. So there's basically two different currents that are going on. One is that you have a longer term trend of interest rates going up that puts downward pressure on bonds. But also when you have a market that's kind of volatile and things that are dropping, people tend to go into bonds as safe havens. So I think that's what's kind of been going on right here. And you can see, today the market had a nice little rally and this kind of dropped. So we're going to see, again, some volatility in bonds, but I think the long term, we're going to continue to see bonds continue to drop. And what I show over here on the left side is that these are all the no transaction fee bond ETFs that really cover all the different sectors. And each one of these columns right here is a moving average. So we have a 10, 20, 30, 50, 100, and 200-day moving average. So what you really want to see is all green dots. But you know what, when you look at all these different sectors, there are a lot of red dots and a lot of negatives. And that's really the universe that we have to choose from when it comes down to the bond portfolio. So when you see like the AGG is negative 2.33% year to date right now. So when you look at your bond portfolio, you're going to be down roughly 2% if you're buying the index. So really what we're trying to do is own the sectors that are actually outperforming the AGG, and so we own many of these here in our portfolio. But again, this is a true example of why you need to be very tactical in your fixed income portfolio. If you just buy just a normal bond fund or whatever, you're taking the risk of dropping more than you may feel comfortable with. And so again, there's different philosophies. You have passive investing, you have active investing, and this is truly an argument for active investing, making sure that you own the sectors in the bond markets that are doing reasonably well and not own the ones that are not doing so well. Okay, so let's kind of get on to the equity markets here for a minute. All right, so this is basically the S&P 500 on a 3-month chart, and you can see right here, this is sort of a continuation. Actually, let me do this. I'm going to go make this a 6-month chart so you can kind of get a better perspective. So here is January 1st right here, and you can see that towards the fourth quarter, we had a great fourth quarter, and then we just skyrocketed in the first 3 weeks of January of this year. And it really, the market really got ahead of itself, and obviously the market had to exhale. And that's what happened right here in the beginning part of February. So we had a huge drop. It was about a 10-12% drop in just about a week or so. And then, we had a nice little rally, and then, a little drop, and we actually, passed this previous resistance line. And then, we've had a number of things happening. We had the President Trump putting sanctions on China, and the markets don't like that. We also had a bit of a, Facebook kind of got some bad press by privacy laws with, the group that the Trump campaign used to, get demographics and all this kind of stuff. So Facebook's kind of taken a hit. Actually, if I just kind of get up Facebook right here, I'll just kind of show you. Facebook obviously has taken a pretty big hit in the last couple days. Also, the president's been slamming Amazon, AMZN. This is another reason why things have been dropping. These are part of the FANG stocks. If you also look at, Google, this is the. I don't even know how to do Google now. But anyway, the bottom line is that most of the technology stocks, if I can just kind of get up here with triple Q, there's a reason why the markets have been taking a bit of a hit. So technology has been really a very strong sector, but it's a sector that has been beaten up pretty badly in recent times. But you know what? This stuff is going to pass. Facebook's not going away. Amazon's not going to go away. And I think this is a short-term kind of blip on time. And so, take a breather. But, I mean, overall, these are strong companies, and they're going to continue to do well. But, at the same time is that, you've got to be careful about, what you own. And is this, is this within your risk tolerance? Can you handle a 12% loss or so? And you just have to be careful about these things. So let's kind of look at the big markets right here. So what I want to show you right here is the main markets. We have the S&P 500, and again, this is what we call the three green arrow chart. And you can see that we have 3 red arrows, which means that we are in a bearish posture. So when you see a red or a pink background, that means that we've turned from bullish to bearish. So we have confirmation of that with the pink background, the red arrow, stochastics dropping, right here. We're definitely in bearish territory. And that's going to be the same thing with the Dow, no different. And the NASDAQ, which I just talked about, as well as the Russell. Russell's hold up a little bit better, but they're all in the same boat. So we see short-term bearishness across all the major markets right here in the U.S., and that's just kind of where we are at the moment. If you actually look at a longer-term chart, the green is obviously bullish, the pink is bearish. The black line right here is actually the 200-day moving average, and the gold or the orange is the 50-day. So if I kind of zoom in on the S&P 500, we are kissing the 200-day moving average, but they have not crossed yet. So if we can hold, that would be a very positive thing. There's been times that we've kind of hit this 200-day moving average and kind of skidded sideways and then kind of bounced off and went up. There's been times that actually, if you kind of go back, go the wrong direction here. This is what happened in 2015, 2016, where the 50 crossed the 200-day, and that happened in August 2015. It happened in the first 6 weeks of 2016. So typically when that 50 crossed the 100, that is definitely a time to be defensive. We are starting to get a little defensive right now, but once that crosses, that's definitely a time to be defensive. Again, that happened back here with the NASDAQ, with the Russell, with the Dow, and so they're all looking about the same right now. So it's been just basically across the board selling in this correction. That's kind of what's happening. So we're kind of crossing our fingers and hoping that things will hit some support and things will kind of bounce back. So that's kind of what's going on a longer term trend. And let's look at the 12 sectors of the S&P 500. So again, with the same thing, there's 3 sectors that actually have a green, the rest are pink. And ironically, or not ironically, the 3 green sectors are the more conservative sectors that tend to do well in falling bearish markets. And that would be consumer staples, utilities, and real estate. So really energy did pretty well today, but it's underperformed. This little gray line right here is the S&P 500, so you can see energy as a sector has dramatically underperformed the S&P. Here's materials, underperformed the S&P. The industrials are actually about even with the S&P. Technology has actually outperformed it, but it's gotten beat up recently. But again, I think technology is going to continue to be pretty strong for the foreseeable future. We're just kind of taking a breather right now. We'll see. Again, it remains to be seen. XLY again has outperformed the S&P, but one reason for this is that Amazon takes up roughly 20-25% of XLY. So that's one of the reasons why XLY is kind of taking it on the chin just fairly recently. But again, XLY has done historically very, very well. You've got telecoms, financials. This is kind of the irony. You think with the interest rates going up that financials would be doing much better than they are, but they've really been kind of taking it on the chin as well. Bank of America, Citigroup, these stocks have not fared very well in this period, which is kind of ironic. You wouldn't think that way with the rise in interest rates. Healthcare is actually right in line with the S&P 500, and that kind of covers our sectors right here. And kind of moving on to international markets. And here we go. A lot of data that my program is trying to pull up right here. So the first thing I want to talk about is the VIX. And the VIX, let me see if I can make this a little longer. Let's make this about a 9-month chart. So you can see the VIX was just doing nothing. It was just no volatility up until February of this year, then just kind of skyrocketed. And if I kind of zoom in on that, you know, we had that big sell-off in early February, and we've had a little bit of spikes right here, but again, things are starting to kind of fall back a bit on the VIX. So again, when you see that VIX spike, that kind of tells us that things are starting to kind of sell off right now. So we had that initial spike, but now things are kind of, you know, they're still a little elevated. They can come down a little bit, but again, as markets calm down, that VIX should calm down as well. This is actually the TNX, the 10-year Treasury yield, and so you can see that the TNX rises right here. And again, as I said, as the yields rise, it puts downward pressure on bonds. So you look right below it, TLT, which is the 20-year Treasury bill, has dropped as that goes up, and you can see as the Treasury yield started to drop right here, TLT went up. So again, these are inversely correlated. I think long term the yield will continue to rise, and I think there'll be continued downward pressure on bonds. What are some other things I want to share? I mean, the dollar continues to be pretty flat, which is actually a good sign. Gold is actually kind of going sideways as well. You would think that with the market dropping that gold would kind of spike up, but it, you know, has these little spikes, but overall it's pretty much going sideways. Commodities have been kind of choppy as well, kind of fallen off recently. Crude oil has actually had a bit of a rally. Obviously, crude is always you know, a volatile commodity, but you know, longer term, then crude has actually gone up a little bit. So you know, that is the story with the I guess the overall sectors. So I mean, that's overall. I mean, that's basically what I wanted to cover in this quarterly video. I mean, overall, the market, we're still in a bull market. We have some short-term, you know, volatility with the you know, with the markets right here, and you know, the things that are starting to get kind of beat up are the tech stocks. So again, I just kind of covered that, but you know, triple Q, it kind of represents the tech, and you kind of see that we've had some bearishness right here, and what's happening is that this green momentum line, once we kind of get into this green zone right here, that's a very bearish sign. So we'll see what happens at the end of the week, but you know, one of the indicators that we have is that if all three of these lines, the green, the red, and the blue, all converge down here all at one time, that's what we call a bullish cluster, and that means that there's a high chance that that particular stock or sector will start to reverse back into a positive territory. Now, it's not guaranteed, but that tends to be the trend when we have what we call a bullish cluster. The same thing is that when things collect, kind of like in this area, that tends to kind of indicate that things will fall in the future. So, you know, that's basically what I have for this market update. You know, overall, the economy is doing well. You know, the market, we have some short-term bearishness. You know, there's some uncertainty with the sanctions and you know, the constant tweets. But I think overall, we're going to end up on a positive note this year. And, you know, as I mentioned, kind of going back to my first slide right here, we've got a lot of workshops. So if you want to join me in one of my workshops, these investment workshops, I go really into detail about all the different investments, how to construct the ideal portfolio, how to create guaranteed income, how to minimize risk, and all these important things that you need to know about your portfolio. So for the meantime, until next quarter, I hope you guys do well and have a wonderful spring, and we will catch you in the next Q2 2018 market recap that I'll do in midsummer. So you guys have a great spring, and we'll catch you next time. Take care.